Essentially what we're saying is that this period, this great moderation that we have seen over the past 4 decades or so around low inflation, low macro volatility has now come to an end. And we are now in a new regime that will be marked by greater market volatility, greater macro volatility, and thus as we are entering a prolonged period of elevated inflation.
So let's talk about that. Between inflation, interest rates or energy, what do you believe to be the biggest wild card for 2023, or is it even central bank policy?
Well, I think I would answer that in the case of it being inflation. Now, yes, we are seeing signs that we're likely past peak inflation in the advanced economies, but I do think if we continue to maybe see some upside inflation surprises, that will then be the determinant of central bank policy. And we know that central banks are trying to engineer so-called soft landings, trying to curtail some of those inflationary pressures while not triggering economic downturns in these economies. So if we start to see those price pressures resume the upside, I would expect that that's probably the key wildcard for investors in the year ahead.
The idea of a soft landing, is that something that BlackRock still believes might happen, or how are you viewing that?
Well, I think over the past few weeks, we have seen the risks of a soft landing widen to a certain degree. But overall, no, this doesn't change our base case scenario in that we do think these are going to be policy-induced recessions coming through in the US and in Europe. If we look at where inflation levels remain now, yes, they are coming off of those peaks, but we do think they're going to remain well supported over the rest of the year. And in turn, we think that we have continued to see policymakers really raise those rates aggressively to try to curtail those price pressures. And in turn, that will cause economic contractions in these advanced economies.
Let's move things to the US. I mean, how are you viewing this tension between what the Fed says it will do in 2023 when it comes to rate hikes and what the market believes the Fed will do?
Well, it's quite interesting in the fact that just the degree of easing that is being priced in by markets over the coming year. They do see those policy rates reaching those peaks by middle of this year, and then having subsequent rate cuts coming through from the Fed, which is in contrast to our view. And we're leaning more on the side of the Fed, more recent comments, that they are likely going to have to see further rate hikes in the pipeline because we are in this still uncomfortably high inflation type of backdrop. Now, that being said, we also think that because the central bank is inducing this recession through tighter financial conditions, they'll be more hesitant to cut rates shortly thereafter. So if anything, we do think policy rates in the US will remain at that restrictive level for some time, in quite contrast to what markets are anticipating, because we don't see this as a traditional business cycle where the Fed comes to the support of economic activity.
On that note, then, with this background that we've just described, what does it mean for investors, especially when it comes to portfolio allocations?
Well, I think the fact we are having this foundation of this new macro regime does suggest that it requires a new investment playbook, largely because we are in an environment where we think inflation will settle at levels above what we saw before the pandemic. So we're still quite cautious on developed market equities, notably because we think that earnings expectations have not accurately priced in the recession risk that we do see potentially materializing through the end of the year. But this is offering quite an attractive opportunity for fixed income. Notably, if we look at the higher quality grades of credit in the investment grade space, we do think that the all-in yields are quite attractive. They provide income opportunity. Despite them potentially seeing some spread widening, we do think that now this is the year where bonds are back.
When it comes to emerging markets, especially now that we've been talking about the China reopen and there's been quite a lot of optimism around that, what's your view on emerging markets?
Well, we're still taking a cautious approach to emerging market allocations in the year ahead. Now, that being said, on a relative basis, we do think there are attractive opportunities in emerging markets relative to developed markets. And one of the key tailwinds behind that view is, as you mentioned, the China reopening. So we do think that China is on pace for a robust growth backdrop this year that should be supportive for the consumer, that should provide a support supportive policy environment as well, we do think that has broader implications for the EM space. And in fact, if we take a step back and look at what positioning from investors is telling us, back in 2022 was a record year for EM equity inflows across the ETF space. So I think that's quite an interesting potential turning point that we could see investors turning much more sanguine on emerging markets this year. Notably as well, if we think about the key challenges for emerging markets over the past couple of years in the sense of Fed tightening and dollar strength, we do think that those two factors will ease even further this year.
We're right in the middle of U.S. earnings season. What are you paying attention to, especially when it comes to some of the commentary from a lot of the executives?
Well, I think it's quite interesting in the fact that earnings estimates, yes, they've come down quite sharply. We do still think they're much too optimistic and not accurately capturing the economic challenges that we do still see coming to the forefront this year. So in terms of what we're watching for in companies' reports, it's largely coming down to their guidance, both on what their expectations are for the consumer. Are we going to be in this period of softening demand from that particular area? And as well, margin pressure. I think so far we have started to see that inflation is eating into more of the bottom line of companies. And that's going to be a key factor that we're going to be watching for ahead as we start to see more downgrades come through in our view.